I'm Basil Cronfley, and I've been a technology journalist for over 10 years, writing for titles including TechRadar and Wired. In my time as a journalist, I've seen Huawei flourish to become the incredible innovator it is today. With Huawei taking pole position as the world's #1 smartphone manufacturer in the last quarter, it shipped more devices than the competition, and its software solution, powered by Huawei Mobile Services, is fundamental to its success. Developers are at the heart of the ways Huawei delights its users, and that's why Huawei's annual Apps Up competition is so important. Apps Up has compiled a diverse judging panel, from technical experts to industry experts through to venture capitalists. The Apps Up journey and Huawei's relationship with its developers is more than just a competition though. That's why Huawei gathered its experts to share their expertise in this Q&A with you, in the hopes that you can gain valuable insights as to how to grow and scale your business and what to look for in the future. Wendy Xiao Schadeck. Based in New York, Wendy is principal at Northzone, an investment firm. She focuses mainly on companies in the health, consumer, fintech, developer, and Web 3.0 infrastructure spaces. Her portfolio includes LivePeer, Spring Health, 3Box, and Open Zeppelin. Prior to Northzone, Wendy founded co-working and childcare company Co-Hatchery and also consulted for transport and retail companies A.T. Kearney and Accenture. Over to New York, where Wendy will field some of your questions. How do you separate your head from your heart when it comes to investing?
Most investors tend to be kind of super analytical, deep thinkers, very left-brained. I think that's sort of, our educational system primes us for that. I think when you're making an investment decision, you really shouldn't and can't separate the two. I think your emotions are always going to impact the way you process kind of your more critical thoughts. And usually I just kind of let both sides of my brain do its job. And one day I'll kind of overanalyze, and the other day I'll feel sort of emotional. But ultimately, I like to think of my emotional brain as the one that sort of synthesizes the most amount of information from sort of observable and unobservable sources. And usually that sort of drives me to make the final decision.
What's the ratio of applications you turned down, and what were your reasons for doing so?
Personally, for me, our role at Northzone is really kind of to lead Series A's. We tend to build pretty concentrated portfolios and take pretty strong ownership for a venture fund in those investments. And so generally, I would only make about 1 to 2 investments a year, each investor. And so that usually comes from evaluating hundreds of companies. And out of those hundreds, I would probably take deeper looks into 10 to 20% of them. And then ultimately, come down to just 1 or 2 investments per year. And so I think that ratio, while kind of daunting, I think it has a lot of kind of objective and subjective criteria baked in. And I think what a lot of founders don't necessarily internalize earlier on in their journey, and I didn't realize this either until I was in venture for a few years, is that you really, an investor has to really have to do the deal in order to write a check. I think there's sort of the more objective criteria. Do we think the market's big enough? Do we think this is the team that's really going to kill it? Do we really, think that they're hitting the market at the right time? Are the customers loving this product, et cetera? But above and beyond that, you have to answer the question, is this investment for me? And am I the one that has to do it? And I think that's where, it is the hardest to explain to a founder while you're passing.
What fascinates you about Web 3.0, and where do you see investment value?
At the highest level, I think what has brought us to this point of the web is these really interesting kind of technologies that have allowed big companies to build these big monopolies because the hooks all point to their ecosystem. And once you have their hooks in their ecosystem, it's hard to let go. And one example of that is AWS. they send you a bill for, it's almost like a tax on your startup every month, and you have to pay it. And there's so many things that they do for you that it's almost impossible to kind of, to go to another vendor. With some caveats, I think we're seeing some of that shift a little bit more now in kind of the Web2 ecosystem. What's interesting about Web3 to me is that the technologies in Web3 allow sort of these most advanced pieces of technology and their hooks to still stay in place while giving a more kind of democratized supply, a set of more democratized supply participants the chance to compete to do that work. So for example, you can still subscribe to one service for video transcoding, and one of our portfolio companies, LivePeer, will allow hundreds, thousands of machines to compete for that work, therefore driving the prices way down. And so it's sort of both the most kind of innovative and efficient things about monopolies, if you study kind of economic theory, while driving prices down to commodity, which is kind of groundbreaking, I think. I think where the value is, so now that you have kind of these value chains completely democratized, is really based on kind of who has the most scarce resource at this time. And arguably, I think compute resource and things like that, they really do kind of get commoditized over time. But right now we're seeing a lot of need for tools for developers to help them onboard this ecosystem. There's just not enough of that. And so that's why we're investing into anything that helps developers build on this new infrastructure, because whoever has that customer first can really kind of capture that first set of value from the infrastructures. And then I think ultimately there's going to be a lot more focus on the identity layer of the web, because right now the identity layer is sort of this hodgepodge of personal data that's combined by various web giants together to triangulate some information about you, and then kind of through a really messy value chain target you specifically and sell you things. I think in Web 3.0, a lot of your data, given it sits on this open layer of the web, can be aggregated down to the one person, and you're kind of the unique identifier, so to speak, in the web that can pull all of that together. And whoever can help you do that, I think, will have a really, really powerful position in the web value chain. And so along those lines, we've invested in a couple of companies, one yet unannounced, and then another one called 3box, which is basically like a decentralized Dropbox for your data that automatically follows you around whenever you use any web services.
A lot of people prefer turning to the internet for medical advice instead of seeing a real doctor. Don't you think a lot of the emerging health startups are actually worsening this trend?
There seems to be kind of this conflict between an individual opinion and sort of voice about his or her own health against kind of the expert opinion, especially here in the US. There's a lot of distrust between the two parties, and I think that's a natural phenomenon based on some of the very kind of big problems that exist in healthcare today. One of those problems is misalignment of incentives. So the healthcare system, and market is such a unique one in that the person who pays for the services doesn't choose the services, and the one that receives the goods is not paying for them, and also sometimes doesn't get to choose for the services. So there's a lot of people in this, a lot of players in this value chain maximizing for their own incentives, but that doesn't necessarily result in kind of better care for the end customer, which is the patient. And then the other problem is that there isn't enough data. There's not enough sort of widely available healthcare data for people to be fully informed and sort of educated about how to think about their own health. I think the population-wide data is just starting to become distributed in sort of this kind of Web 1.0 paradigm, which is a one-to-many way of disseminating data, where an authoritative voice says, this is what is good for you, and here's sort of all the information you need to know about it. I think we'll start to see more innovative models of kind of the Web 2 paradigm of distributing data, which is peer-to-peer, and you start to see more kind of online discussion of more complex systems and more complex symptoms. And that will hopefully lead to kind of just greater education overall of the population on these complex healthcare issues. And then thirdly, we just don't have great tracking of individual data throughout their lifetime. And so that also means when you go to a doctor, the doctor will ask you, maybe 5 or 10 questions in the limited time that they have to fully try to diagnose your entire lifetime or sort of questions. And you feel like they really don't know what they're talking about because they haven't lived with this condition their whole life. And they feel like you've been Googling too much because you have all of this sort of anecdote that you want to bring in context you want to bring, but they don't have the time or the systems to be able to process all that. And I think that's where kind of, the conflict arises and the mistrust arises. I think healthcare startups are both solving the data problem and the incentive problem in order to survive against the healthcare incumbents, which are humongous. And so I think they're actually, doing a lot to hopefully pave the way for this conflict to disappear in the future.
How involved is your team in your portfolio company's decision-making and routine operations?
I think every investor has a different style, and certainly with every company at different points of its journey, in terms of how involved and when and where and exactly how to be involved. So there's a very, it's very hard to kind of write a short and fast rule for this, though I will say it's probably a little bit unusual to see a venture investor be routinely involved in the routine operational ongoings of a company. I think that is a sign that typically you don't want to see, because I think the best entrepreneurs kind of want their investors out of their hair when they don't need to be. And then, but then on the other hand, I also have a good relationship with most of my, with all of my founders, and some of them will just randomly text me things like, "Oh, I read this today, and I think I thought of you," and vice versa. And I think those sort of more informal interactions outside of the board can be the most helpful, if not being kind of a decision maker alongside them, but being more of a thought partner where you're both learning from each other and learning from kind of your different informational sources.
What are the products or technologies that you regret not having invested in?
So I think when I first joined Northzone, I went pretty deep into the influencer ecosystem, and I wrote this whole piece about it with our partner Jessica, and we did a lot of research and spent a lot of time with companies in the influencer space. This was on the back of some of the investments we had done, kind of earlier on in that space. There was a company called Blogleven, for example, from Sweden. That was one of the first blogger platforms. And then Jessica had done an investment in a company called Naked, which is NA-KD. It's a influencer commerce platform. And we learned that, influencers were really trying to kind of first build their audience, but once they had done that, monetize, their influence as media properties, basically outside of Facebook and Instagram. And we were looking for many ways of that happening. And I think just, this was back in 2016. It was a little bit early. And so there weren't that many sort of instances of this happening. And we saw a lot of really interesting platform and media models. But now I think there has been this kind of rejuvenation in kind of the word influencer. It's not even called influencer anymore. It's called creator, where everyone is a creator and you're monetizing your own talents on a micro scale. And I think a lot of people call this the passion economy or the work economy, or, I think this is also a conjunction of what happened with the gig economy. I think these two things are converging. But it's a really fascinating space to me. I think this is still going to be something that I track, but I'm a little bit, I guess I just haven't seen sort of the right investments in that space when I started looking until now, but hopefully I continue to see more.
Which app has changed your life?
Right now, I'm using this really cool one called Aura. It's a wearable ring that I think this ties a bit back to the conversation earlier about sort of individual health data. It's a ring that you wear. I'm wearing it right now, and you can basically see your heart rate, your sleep, your temperature variance data throughout the day and understand a lot about your own body just through kind of, again, your left brain and sort of these analytical inputs and tying that to how you feel that day. I think this is still an early iteration of what we can do with data in healthcare, but I'm really excited to see more companies like this that really, help you understand your own body and tie it to actual data.
What do you think is the next big thing in fintech?
I think decentralized finance, I think that's going to be huge. I don't know if you guys have heard the buzzword DeFi, but that's, essentially what it is. It's these Web 3.0 protocols that have smart contract functionality for finance innately baked into the code. Things like payments, the most kind of basic form, peer-to-peer transfer value, but also lending, so collateralized, lending where you tie up some of your assets and the protocol gives you a loan back in another denomination, or options you can trade, on specific token movements of certain baskets, and if the price goes above X, you automatically get more money or you lose money, or even ETFs, you can buy into a basket of tokens. So these are kind of core fundamental building blocks of our financial system that are being built into code. And many of these protocols have liquidity and it innately baked in. There's usually some sort of speculative yield that people can earn by investing into them. And so, I think that is interesting for two reasons. One, it allows us to build these complex financial use cases without having to rely on working with, like a Visa or another centralized kind of large financial services company with their own liquidity capital. And then two, I think it could theoretically abstract away fintech altogether. It could allow a product company to build working finance capital or working capital financing directly into the product, where a seller wants to sell, a new kind of set of inventory, and instead of having to go to the bank, get the loan, and then come back buy it, they could actually get the loan from the platform and then take the risk out of that transaction for the seller. And so I expect we'll see a lot more fintech innovations be built into things like e-commerce, like media. Imagine a video streaming platform where a creator, an influencer, can not pay any AWS bills until their audience pays to watch their videos. So they don't have to, and the contract self-regulates, and the first kind of streaming dollars they get goes directly into their hardware services for running their video transcoding or cloud storage or whatever. So I think there's a lot of like complex financial pieces that get abstracted away by these protocols. And that's what's pretty exciting to me about kind of the next wave of fintech. And we're already seeing it in sort of Web 2 companies now, but they're doing it on traditional fintech rails. There's a company called Fair out of the West Coast coming out of YC. It grew very quickly. It's basically an Etsy for wholesale. And so, what boutique owners like about it is they can get the inventory, don't have to pay for any of it until it sells through. So basically what Fair does is it gives them working capital financing while they get the inventory. And if it doesn't sell through, they can just ship it back. And so that takes the risk out of having to, to buy sort of that inventory yourself. And if it doesn't sell through, you have to pay for it. It automatically comes with the platform. And so I think these things are starting to connect. And I think the Web3 vision is a sort of, it happens kind of innately in all products, and anyone can build on top of them.
Let's imagine a startup asks for X sum of money. How do you evaluate that it needs exactly that and not half it or double it?
I think the most important thing we evaluate is the founders have a very clear and iterative model on how they think about growth and capital expenditure along with growth. So we may ask them questions to help understand their assumptions underlying that model, but I don't think we ever come into a case being like, I think they need to raise this much. Let's see if their answer matches up with mine. Thanks for having me today. I'm excited to see your entries. Stay safe and stay creative.